Thank you very much, Clemens. Thanks for the invitation. It's a great pleasure for me to be here in this beautiful town. It's a town that really feels Flemish, if I may say so, but it's a Dutch town, of course. No misunderstanding here. So I like to come back to Maastricht. I've been here many, many times, and I've met Clemens also many, many times in my life. I think, was it the first time we met, was that in Constance?
I think so, yes.
So you know, it used to be a long time ago, when Brunner and Meltzer were still very popular, and they organized a conference in Constance at the lake of Constance, and we spent there usually a week, and this was quite a happy time, I must say, and I learned a lot. I was a junior like you, and I learned a lot there. But since then, we have met again at different places, and so I'm very pleased to be here. What I want to talk about is what I call the fragility of the Eurozone, and I will ask the question, is that something temporary, or should we expect this to be with us for some time? Right? So let me outline what I want to tell you today. So I want actually to revisit this fragility problem of the Eurozone, and I will define what I mean with that, right? And then I will document how it has evolved over time, and I will show that, yes, there have been reforms in the governance of the Eurozone, especially since the sovereign debt crisis of 2010-2012, that have been quite important and allow us to understand why the system later on appeared to be more robust than it used to be prior to that. But then I will also say something about the inflation research of today and ask the question whether that is something that could lead to a new crisis, right? And then I will end with a discussion of the prospects for the future. So let me define what I mean with fragility. The Eurozone is a fragile construction. And it has to do with the following. When countries join a monetary union, the governments of that country have to issue bonds, which is, in fact, like a foreign currency, right? And when they issue bonds, they promise to convert it at maturity, but this is going to be a currency over which they have no control. In contrast with the situation that existed prior to joining the monetary union, each of these countries was issuing bonds in their own currency, and as a result, they had a control over that issue. So, and as I said, it is as if these governments issued debt in a foreign currency. Think of the member countries of the Eurozone as being Argentinas that issue debt in dollars, and that makes you fragile, right? Why is that? Why does it make it fragile? Well, actually, these governments cannot give 100% guarantee to the bondholders that they will have the necessary liquidity to repay them at maturity, right? Because they could literally run out of money. And the fact that they can run out of cash, euro, right, a foreign currency, creates a potential for self-fulfilling crisis. Right? That may force the governments to default. I will elaborate on this a little later, but you can see already the idea. You fear a liquidity crisis. You do a number of things that actually realize your fears. And Franklin Roosevelt once said, the thing that we should fear most are our own fears, right? So that's at the core of the problem. So this problem does not exist in standalone countries because they issue their debt in their own currency. And investors know that these governments will never run out of cash because there is a central bank capable and willing and probably forced to provide cash to the governments in times of crisis. Right? Think of the British government today, the Bank of England. Right? The British government is in trouble. What does the Bank of England do? Immediately, unconditionally support the government. Right? And therefore, this type of self-fulfilling crisis cannot easily arise. Of course, governments can always default, but that is going to be their own choice, right? that contrasts with a monetary union, because there investors can actually force governments into default, right? And this is something quite peculiar and paradoxical in a certain way in a monetary union. When we join, you might have thought that by joining the monetary union, each of these member countries are stronger because they're in a union. Huh? We like to think that if you are together, you are stronger. No, you are weaker. You have been weakened. And there has been a change in the balance of power between sovereigns and financial markets. Financial markets actually have gained in power vis-à-vis these sovereigns once these sovereigns became part of a monetary union. That's the paradox, right? And we clearly have to do something to solve this, otherwise this thing cannot continue to exist, right? But I will come back to all this later, okay? Let me say something about fixed exchange rates. Fixed exchange rate systems have a similar problem. That is, their central banks promise to convert the national currency into a foreign currency. Right? But they may not have the foreign currency at some point. And as a result, doubts will exist about the capacity of these central banks to do that. Right? And as a result, self-fulfilling liquidity crisis can erupt, bringing down the central bank, i.e. forcing the central bank to devalue the currency. So there's a similar structure there between fixed exchange rate systems and a monetary union. And I want to show you this in the following way. Here I show you the spreads, 10-year government bond spreads in the Eurozone from 1991 to today, right? I start, so it's a 30-year period, right? And so these are the spreads. By that I mean the difference of the yields of each of these countries with the yield on 10-year German bonds that are considered to be risk-free. So the premia measure some risk. Right? And now look at, so this gives, in one picture, a lot of information about what was going on. You look at the 1990s here, right? And what you see, well, there were large spreads. So this is Greece, right? Italy, right? So what was going on in the 1990s when investors bought, say, Italian bonds, right? They knew that these were issued in lira, right? These were lira bonds. They knew that the Italian government could devalue the lira. If you hold a 10-year bond, as an investor, what do you do? Well, you want a risk premium, because during these 10 years, the lira can devalue, and as a result, you make losses. Therefore, you want to be compensated by these losses, and as a result, here you can see that the lira, during that period, typically had spreads vis-à-vis Germany of about 5% a year. So there was an implicit expectation in the market that the lira would devalue in the 10-year in the future, on average by 5% a year, right? And that necessitated these kind of spreads. Okay. For Greece, it was even worse, as you can see. Then an agreement was made here around the middle of the 1990s to form a monetary union, and you can see that the spreads started to disappear. For Greece, it came later, because also Greece entered 3 years later. And then you had a period here, a honeymoon period. And then suddenly the spreads increased again. But now note the nature of the risk had changed. Here it was devaluation risk, right? Here there was no devaluation risk anymore, because all these countries were part of the Eurozone. There was no devaluation risk, but something else, namely a default risk. Suddenly investors realized, hey, but maybe the Greek bonds are not that attractive in terms of risk. And you had a huge increase in spreads, Italy also. And this leads to the following problem. Is there an original sin in this system? Here what I do is the following. I set out the spreads the average spreads during the 1990s of these countries, right? And on the vertical axis, I set out the average spreads during the period 2008-2012. And then, so this is Greece here. You can see high spreads there, and these are averages. You saw the peak of 30%, but these are averages. And you can see that the spreads that existed in the 1990s are a good predictor, a relatively good predictor, R square 0.8, a relatively good predictor of the spreads that would exist 20 years later. Right? In fact, it's even more spectacular. I did the same thing, and on the horizontal axis, I set out the same spreads of the 1990s and asked the question, is that a good predictor for the recent surge in the spreads that we have seen in 2022, this year? You have seen the spreads have surged again. I will come back to that. Is what happened during the 1990s a good predictor of the surge in the spreads recently? And the answer is yes, it's a relatively good predictor. That is, those who were in trouble in the 1990s, well, they are the same, who are in trouble today. And the ranking is also more or less what happened in those days. So there seems to be an original sin. Now you know this idea of an original sin. I don't have to explain in a Calvinistic country, but in Maastricht, Calvinism has not been that influential, right? Anyway, so this is certainly an interesting thing to observe, right? But now let me focus on the period during the Eurozone, right? So I just left out here the 1990s, and I concentrate on the period from 2000 until now 2022, right? And so I distinguished three periods: the pre-crisis, the crisis, and the post-crisis period. And now what we observe is the following. During the pre-crisis period, the spreads were practically zero. Here you have Greece that had not yet entered, but then once it had entered, the spreads were practically zero. So this was a situation, I've called it a honeymoon situation, where the markets were saying, if you buy a Greek bond, that's the same as a German bond. When we think about this today, how come during almost 10 years people actually, investors, you would think they are clever, right? Investors, and they have considered Greek bonds in terms of risk to be perfect substitutes or close to perfect substitutes with German bonds. That can be, right? It didn't last forever. Then came the wake-up call here, the crisis, the financial crisis that erupted. Whoops, okay. Here, then suddenly these spreads exploded, right? And then later on, they went down again. So I will go to these episodes immediately. So as I said, the pre-crisis period, the remarkable situation, the markets were thinking that Greek and German bonds is the same, right? The financial crisis led then to a complete change in risk perception in the government bond markets. And in particular, some countries were hit more than others, and as a result, came into trouble. As national government bond markets lacked a backstop, central bank, willing to provide liquidity in the government bond market, a self-fulfilling liquidity crisis was set in motion. Right? Let me go to the anatomy of a self-fulfilling crisis, as we have experienced in those days, right? Panicky investors, fearing that these governments would face difficulties in funding the rollover of their debt, sell the bonds massively, thereby creating actually the liquidity shortage that they were afraid of, and the yields on these bonds shoots up. And at the same time, the liquidity so when investors sell, say, Spanish bonds, which happened in those days, the liquidity that they get when they do that, the euros, they invest it in German and Dutch bond markets, and you get a massive flow of capital within the system, and leading to a decline in the yields in Germany and the Netherlands, right? You have a surge in the risk countries and a decline in the other countries, right? Total repricing of risk, suddenly it arose like this. It's very peculiar, because if you looked at the macroeconomic data prior to the crisis, you could already have seen it, right? But investors were blind, right? Those who believe that markets, financial markets, are a source of discipline should rethink that, right? What we see is that, well, on average, financial markets are a source of discipline. But during boom and euphoria, they are a source of indiscipline. And when the crash comes, they impose too much discipline, right? So that on average, the discipline is fine. But most of the time, it's wrong, right? And so that's what happened also in the Eurozone. And this led to what I call the occurrence of good and bad equilibria, right? The governments in high-risk bond markets were pushed in a bad equilibrium. Why? Well, they were running out of cash. What do you do as a government when you run out of cash and you don't have a central bank to provide you the cash? Right? I'm talking about the period just prior to 2012. I will come back to that. What do? Well, you raise taxes and you reduce spending. When do you have to do it? In a recession. What does that mean? That you intensify the recession and you are pushed into a bad equilibrium, right? So the markets actually forced austerity programs on these countries. Official institutions like the Commission and others also helped the financial markets in doing this, right? In imposing austerity during recessions. And we know that you shouldn't do that during recessions, right? Because you make recessions deeper. It took some years for the officials to realize this and to have a mea culpa, saying, yes, this was a mistake, right? In the low-risk countries, it was exactly the opposite. Their cash was plenty; it was flowing in en masse, and they could escape austerity. But some countries, for reasons of, I don't know, maybe also Calvinism, wanted to do austerity anyway, right? Although it was not necessary, right? But anyway, I'm not going to pursue that line of argument. So what we learned there is that in times of crisis and in the absence of a lender of last resort, the government bond markets in the monetary union become highly unstable, right? Large spreads, massive flow of capital, pretty much like foreign exchange markets in fixed exchange rates. So that's why I showed you these spreads, right? They're very similar, right? The same mechanism, actually, were working in the 1990s and later on. And so what we have seen is that when we moved into a monetary union, we eliminated the risks in foreign exchange markets. How? By eliminating the foreign exchange markets, right? We just did away with foreign exchange market within the system, and so no trouble anymore for foreign exchange market, but the inherent instability was not eliminated because it was shifted to the government bond markets. What before was going on in the foreign exchange market was shifted to government bond markets, right? And pretty much the same countries were actually involved in this. Then, so I had pre-crisis, crisis, and the post-crisis that I call the post-crisis from 2012, when the ECB came to realize that, yes, it has to do something, right? The ECB people were hanging over the cliff. They were not in suicide mode, right? And as a result, they decided, we have to do something, otherwise we also disappear, right? And that was Draghi's announcement, first in London in July, and then in September 2012 with the outright monetary transaction, where the ECB announced the OMT program, right? They didn't want to call it lender of last resort. My expectation was that they would call it lender of last resort, but no, that was not acceptable. So the ECB is a master in finding acronyms, yeah? OMT, that most people don't understand, right? And now they have new, the PEPP, and the last one is something that I forgot, also an acronym. Anyway, so this was actually a lender of last resort facility that the ECB was announcing, saying we are willing to provide unlimited support in government bond markets by buying these government bonds, right? And this worked like a wonder. I mean, the spreads collapsed, right? There was a second bump for Greek, but ultimately there was a very strong convergence of the yields at the end of 2019. Not fully, when you look at the graph that I showed you earlier, not fully like we have seen before the financial crisis, but pretty close. I will come back to that in a moment. So this was about rebuilding confidence, right? When the purchase of the promise to do that took out the fear factor from the market. So the market were dominated by panic and fear, right? You were panicking, saying, the Greek, the Italians, I have these bonds here, let's get out of this. And everybody runs to the exit. And we know what happens when everybody at the same time runs to the exit, right? And then the ECB stood up like Deus ex machina, you know, coming from heaven, say, don't worry, don't be afraid. I'm willing and capable of providing all the liquidity necessary to deal with this. And it worked. People believed it. And the ECB didn't have to buy €1 of these bonds. Because what happened, suddenly, private investors realized that, well, the risk that we thought existed in the Greek bonds was a little exaggerated. This was the result of panic. There was no reason to be panicky anymore. And as a result, they were willing to buy and make a lot of money, right? And they bought massive amounts of Greek bonds, Italian bonds, Spanish bonds. And as a result, prices shot up and spreads declined, right? So this was something. This is one policy measure that you can say, this worked, right? I mean, it's amazing. Yeah? Just by doing the right thing, thinking what the nature of the problem is. The problem before was that everybody was saying, and these countries are insolvent. Okay, you could make that argument for Greece that it was insolvent, but not for Spain or Italy. They were just facing a liquidity crisis because people thought they were insolvent, right? And then sold massive amounts. But many economists were saying in those days, these governments, Spain is insolvent, so what do you do when you are insolvent? You have to reduce spending, increase taxes, and all that. Exactly the wrong advice, right? You shouldn't do that, and what you should do is to provide liquidity, right? Because this was a liquidity crisis, and that's what the ECB understood. It took it 2 years, though, to understand it, right? It could have understood a little earlier, but anyway, it was progress. Here I show you, and I have to take into account the timing, just the spreads, you know. So I want to check whether the decline in the spreads that we observed after the announcement, right, was the result of the announcement, or maybe the fundamentals changed, right? So here, what I do, I have the initial spread. So here, this Greece, right? This is at the moment of the announcement, the spread was 30% in Greece, right? And then, so these were all the spreads in the beginning. And here I set out the change in the spreads subsequent to this announcement, right? And it's an almost perfect fit, 0.977, right? So it basically, the higher your spread was, the steeper would be the decline. And you can actually see it visually when you look at the spread that I showed you earlier, right? It's just the announcement that did it. Did fundamentals play a role? Here I set out the change in the debt to GDP ratio during the period 2012-13, subsequent to the OMT announcement, and here the change in the spread, same period as before. And what you see, no relation. Well, actually, there is a wrong relationship. Countries like, I think, let me see, this must be Greece here. Yeah. Had the biggest decline in the spreads, but still its debt to GDP ratio was increasing. So you should have, if fundamentals played a role, you should have expected a positive relationship, right? It's the wrong, but it's not significant. And so I don't want to say anything about it, just to say that the subsequent movements in the debt to GDP ratio had no bearing for the decline. It was a pure announcement, right? Okay. Then came the pandemic in 2020. And there was actually a risk that this shock would trigger a new sovereign debt crisis. And people were started to talk about this, right? Mainly because actually it was you might say, well, why was there a risk for a sovereign debt crisis? This was like a symmetric shock. Everybody was affected by it. But actually, when you look at the data, you find that the shocks were not, I mean, the effects were very different, right? Here I show you the growth, the GDP growth during 2020. Right? And you can see wide differences among Eurozone countries. Right? This is Ireland. Never believe GDP numbers of Ireland. It's all fake. It has to do with these investments, you know, the Apples and the Googles and what have you, who in their books put it all in Ireland, and the Irish put that in their GDP, right? So there was one year, I think in 2015, GDP in Ireland increased by 30%. 30%, can you imagine? It's not possible that in 1 year your GDP, actually production of goods and services, increases by 30%. It was also all fake. So don't believe GDP numbers ever of Ireland. Okay, and sometimes I wonder about some other countries also, because they have also special deals with multinationals and all that. But again, it's not something I want to talk about. Okay, so what you can see now is that the pandemic here, I've actually the same spread that I showed you earlier, but over a shorter period from 2019 until in May this year, or June of this year, right? So it's a blow up of that previous. And here's the start of the pandemic, March 2020, right? And you can see a short blip here, Italian and Greek, but then a decline. So apparently the pandemic had very little impact on the spreads, right? After just 2 or 3 months, they declined. Here, something new happened. I will come back to that, inflation and the risk that we can expect from that. So why did the pandemic not lead to a crisis? And then my answer is very simple, and you can already guess it. It has to do with the new governance that we had created already after the sovereign debt crisis, and the new things that we did. And they were in the monetary and in the fiscal field. Right? The monetary instrument is the OMT program that started in 2012, that was there, and investors expected this to still be there, right? Because this was something, an insurance mechanism that existed. But in addition, the ECB announced its Pandemic Emergency Purchase Program, PEPP. It announced that, and this had an additional effect of reducing the spread. So this was actually a little different from the OMT program that, as you may know, has conditionality in there, right? Countries that use OMT are supposed to accept a program that is designed by the European Stability Mechanism, and which is an issue that we might want to discuss. Do you have to add conditions when you provide liquidity? Note the Bank of England yesterday started providing liquidity in the government bond market. No conditions, right? The Bank of England didn't tell Liz Truss, listen, we are willing to give you liquidity, but you have to do this and this and this and this. No way, right? The Bank of England, unconditional. OMT is conditional, creates a question mark. But the PEPP was not conditional, so this was the new thing, right? It was an unconditional system that has created some unhappiness in some countries. But this worked, certainly. And then we had the fiscal instrument that you know, and this Next Generation EU program that was new in the sense of issue of euro bonds and a transfer of part of it in the form of subsidies to not loans to countries that were most hit by the pandemic. And these two things helped to strengthen the the Eurozone, right, and prevented the kind of crisis that we have seen before. So it was quite powerful. So we have done something, right? We have strengthened the governance of the Eurozone that made it possible to sustain a shock like the pandemic, right? So in a way, you can say that especially this fiscal thing was a first step towards a budgetary union. It's still far from a full monetary union, but it's part of it. The central authority obtains the power to issue debt that is guaranteed jointly by all member countries, right? That's what we did, right? And that, of course, has also been an important step. Now I turn to inflation, right? I show you the same spreads again, but I will concentrate on this year. Since the end of last year, when inflation surged, we also see that the spreads have been surged. These are the spreads, right? So they have been going up. Up to now, it has been relatively limited, but they could increase further, right, depending on what happens. So let me turn now to that analysis. What is the challenge of the inflation in the Eurozone? And here I would argue the following. The inflation that we observe today in the Eurozone creates two types of dilemmas. One is the first dilemma arises from the fact that there is a supply shock, and it's a dilemma that all central banks face today, right? There is an increase in energy prices and commodity prices, the cost of productions shoot up, the supply curve shifts up and to the left, right? And this leads to a surge in inflation. It also leads to a loss of purchasing power, so that production is also negatively affected, and we turn into a stagflation, right? And that creates a dilemma situation for a central bank. How can I describe this? Well, if the central bank wants to fight inflation, right? The inflation shoots up today dramatically, it has to raise interest rates. But this will have a negative effect on production and may even lead to a recession or a deeper recession. So, on the other hand, if the central bank says we don't want to have a recession, then it cannot raise the interest rate, but then inflation may be higher and be more ingrained in the system. So it's a difficult choice. It has to make a choice, right? What do you want to do? You want to fight inflation or you want a recession? And you can't have both, right? That's a dilemma situation, a conflict situation. Note that this is very different from a demand shock. A negative demand shock has the effect of reducing output and prices, and therefore then you can lower the interest rate and you come closer to both objectives, right? But with the supply shock, that's the dilemma, and we see it. Central banks have been hesitating. What should they do? Lots of criticism. You shouldn't do that. People now in the US, some economists say the Fed is overdoing it, raising the interest rate too much. This will lead to unnecessary decline in production. So the typical dilemma that we see going on, right? Second dilemma, so now I've come to my point about the Eurozone, which is a particular situation for a central bank. There is one central bank and 19 countries, right? And that creates another type of dilemma, which has to do with the fact that when the ECB raises the interest rate, this has different effects on the long-term bond rates of different member countries. So every 1 percentage point increase in the long-term rate of Germany leads to an amplified effect on the long-term rate in high-risk countries. Let me show you the, whoops. Yeah, here. I show this here. Here I show the change in yield for every unit change in a German yield on 10-year government bonds, right? So here, countries like Luxembourg, Ireland, France, it's very close to 1. In other words, when the German bond rate increased by 1 percentage point, then in these countries, where is the Netherlands? Ah, here. Huh? It's a little higher. Even higher than Belgium. I can't believe that. But here you can see Italy and Greece, for each 1 percentage point increase, they have 1.5 or close to 1.6 percentage point increases, right? Now, I'm not saying this is just the recent past, huh? This may be more. If you really get into a panic situation, then these numbers will increase. But still, there is there in the system this effect that when the German bond rate increases, in the high-risk countries, the yields increase with the multiplier effect. So that's what we observe, and that leads to that dilemma, right? So the second dilemma that the ECB faces is one between fighting inflation at the risk of creating financial instability. Or, if you fight financial instability, you have the risk of losing the battle against inflation. So it's also uncomfortable, right? You have to make a choice. This may also explain why the ECB has been slower in raising the interest rate compared to the Bank of England or the Federal Reserve. The fear that this may lead to financial instability. Right? Is there a way out of this second dilemma? And then I say yes, but it remains risky. One way is to announce that the ECB will provide or continue to provide unlimited amount of liquidity to countries experiencing liquidity shortages. And these are the countries whose spreads are increasing faster, right? And in fact, that's what the ECB did. In July of this year, the ECB announced a new program. Look again at the acronym here, TPI now, Transmission Protection Program. It's all lender of last resort, huh? They could just use the same name. But it's TPI, which does exactly that, provide liquidity to governments experiencing liquidity crisis. So that's what the ECB is aware of this problem and has announced that it will do. It's being criticized in a number of countries. But, of course, the problem of this mechanism is that it provides additional liquidity in the market, right? When the ECB, at a certain point, decides to buy Italian bonds and Greek bonds because the spreads increase too much, then it increases the money base, right? It buys these bonds, and as a result, liquidity, the money base, increases in the system. And that will interfere in its fight, its stance of fighting inflation. So you get into the first dilemma also, right? So can the ECB deal with that? In principle, it can. It can actually, when it buys, say, Italian bonds, sell Dutch bonds or German bonds, right? In other words, change the composition of its balance sheet, acquire more Italian and Greek bonds and less Dutch and German bonds on its balance sheets. You can see that in many countries some nervousness will arise about this situation, right? And it may create political problems. But in fact, the ECB is already doing this in the context of its PEPP. And you know that the idea of these programs is that when bonds come to maturity, up to now the ECB has said we will reinvest in bonds. In the past, this was just, if it's a German bond that comes to maturity, you buy a new German bond, right? An existing bond in the secondary market, right? To maintain your bond holdings in German bonds constant. But now the PPP allows some flexibility, and you can see that here the ECB has reduced its holding of German bonds here and also of Dutch bonds, and has increased its holdings of Spanish and Italian bonds. This was during the period June to July. So and these are billions, right? So he had 15 billion less German bonds, but 10 billion and 5 billion more Spanish and Italian bonds. So it's already doing this, right? To fine-tune the spreads. 5 minutes? Okay, that turns out okay. So to conclude then, prospects for the future. What are the prospects for the future? So I've sketched with you the history of this fragility thing, argued that we have done a number of things to strengthen the system, and the role of the ECB has been central in all this. The question is about the future, right? And especially now that inflation is surging, right? Will that surge in inflation and the need to increase interest rates not reveal again the fragility of the Eurozone? I have already indicated why that could happen. The ECB will have to do certain things that some countries may not like at all. So this is also the question here, whether the Eurozone has matured and has permanently eliminated its fragile nature. And here I come back to something very fundamental, the contrast between the Eurozone and standalone countries. And we have seen it in the last few days. Standalone countries like Britain, right, their own central bank, there's no doubt there that if governments of these countries are in trouble, the central bank would provide the liquidity, right? Because the government prevails, stands above the central bank, and rightly so, right? In the Eurozone, things are different, right? The ECB faces 19 sovereigns, none of which has authority over the ECB, none of which can say you have to provide the liquidity the way the UK government can say that to the Bank of England, right? And therefore, this whole thing depends on the discretion of the central bank, right? And this creates uncertainty. What is the future central bank going to do? Well, we are not sure. Huh? We can have reasonable doubts about its willingness to continue and go doing these things. Who will be at the helm of the central bank at that time? Will the governing council change its composition all the time? Or will they be willing to support a particular member country when it's in trouble? We cannot be sure about this, right? And as a result, there's a fundamental credibility issue about the willingness of the ECB to be the lender of last resort in the government model. And that's still there in the structure, right? And this will combine, and will continue to make the Eurozone a fragile construction. You can only eliminate it by radical steps like political union, having a European government and one budget and all that, but we can only dream of this. So, and I will stop with a dream. Thank you for your attention.
Thank you very much, Paul, for a very inspiring speech. Unfortunately, those on the live stream cannot ask questions, but I hope you can enjoy the answers of the questions that were raised to you. And there is already a first question. So please say your name and then ask. Try to be short in your questions so that we have sufficient time. And I will extend the session a little bit because we started late, so you'll have to squeeze your lunch a little bit so that we can have a little bit more fun in the discussion. Go ahead.
Thank you very much, Professor De Grauwe. I hope it's working. I am reading you since 1997. We've been in touch by email 10 years ago, but I have two short questions. First of all, do you expect a pivot in terms of monetary policy of ECB in the short run, given the recessionary outlook for the Eurozone? And the second one regards the global financial architecture. Do you think it's now the moment to have a change of the remainings of the Bretton Woods system? Thank you very much.
Okay. Your first question is about what the ECB should do in the short run, right? Yeah, it's a very difficult question for the reason that I gave you, right? The ECB is in a dilemma situation on two fronts. The one is inflation versus recession, and the other one is inflation versus financial stability. So there are actually three issues there, right, that the ECB has to balance. I do think, though, that the ECB should maintain its primary objective, which is to maintain price stability. Right? This is in its statutes, and the statutes literally say that price stability is the primary objective of the ECB. But it adds to that, as you know, that provided this objective is guaranteed, it should do a number of other things, including financial stability. So this will be the hard trick. So it should maintain this primary responsibility for price stability, and then also act if these spreads tend to increase too much. Right? And this may happen because today still the interest rates that the ECB has come out with are relatively low, right? And it's quite likely that if it wants to successfully fight inflation, it will have to raise it significantly, right? Not at the level of 1.5 or something, but 2, 3, 4, 5%. And what is the implication going to be then on these spreads, right? And at that moment, the ECB will have to be willing to also provide liquidity in these markets, and at the cost of what I told you there, changing the balance sheet, right? But this will clearly create political issues, right? That I don't have to convince you of, and so it remains risky. I think the ECB has the tools to do it, economically speaking, but it may not have the political architecture and environment that will allow this to happen. So that's what I can say about your first question. Yeah. On the worldwide financial architecture, I'll be relatively short about this. Since I'm an economist, we have been talking about reforming the international monetary and financial system, and basically nothing has come out of this. So I don't expect anything to happen there. It's just a competition between major currencies and financial systems. And some people say, well, maybe China will come up, but I don't think so. China has a closed system, and this will, as a result, the yuan will never become a true world currency. But we will have to live with the fact that we have competing currencies, and this can create, once in a while, large movements, turbulence, basically in foreign exchange rates. Huh? And we can live with that. In the 1980s, look at what happened with the dollar. The dollar, in the first half of the 1980s, doubled in value, creating huge tension. People said, it's terrible, the world is going to collapse. And then from 1985 on, it halved in value again, right? So over 8 or 9 year period, it went full circle. So these things have happened. Today the dollar is very strong, but it will go down again, right? What goes up must come down.
Thank you. Oh, many questions. I'll move there first.
Stefan Immerfall from the University of Education in Germany. Thank you very much for your very useful survey over sins and salvation. But on the salvation side, you were a little bit short, I must say. My question is the following. You argue that issuing Eurobonds is like issuing it in a foreign currency. But if that is so, then why are German bonds considered risk-free?
But, national governments issue their bonds in the same currency, the euro, right? And your question is, why is the German bond risk-free compared to other currencies? Not really compared to the Netherlands, but almost, right? Yeah, because the history of Germany in the post-war period has been one of stability, and this has created a perception that when you invest in these currencies, you have a safer asset than if you invest in, say, a Greek bond or an Italian bond issued by governments that don't have the same history of the past. And that creates a different perception about risk. Okay? So that's my answer. I don't know whether you had some subtle other question there around the corner, but that's my answer. Yeah.
Okay, we go first there, then there. Yes.
Thank you very much, Professor Konstantinos Chazakis from Greece. I have two short questions, Professor. If there will be a common European credit risk assessment agency, do you think that it will make better the uncertainty of expectations issue in markets? And my second question, do you think that there are efficient and robust mechanisms in EU to isolate monetary and systemic banking crisis in Eurozone?
Mm-hmm. So your first question about creating a rating agency, a common rating agency. I don't think this will matter. I cannot see how this would matter. There have been attempts to do that, but yeah, we have rating agencies, and adding another one, we'll just have another rating agency doing basically the same thing. And note the following: these rating agencies look at each other, right? They usually don't understand very well what was going on. I still remember during the sovereign debt crisis, suddenly I was looking at Belgium, right? Suddenly the spreads of Belgium went up during that week. Nothing happened. The rating agencies had actually forgotten about Belgium for some reason. It's such an unimportant country that they probably had no desk officer looking at Belgium, right? But then suddenly the spreads went up, and probably the boss of this rating agency said, we forgot to look at Belgium. It's time we look at this. So then they started looking at this, and then they said, oh yeah, we have to increase the rating. I mean, downgrade the rating. Huh? That's how it typically works, right? So adding another rating agency will not do much. You want to contest this? Okay. Okay. Yeah, and your second question, now I forgot that.
My second one, do you think that there are efficient mechanisms to isolate the monetary crisis from systemic banking crisis? This is a very important question. So I didn't say much about this, but when I described the bad equilibrium, then typically, when countries are pushed into a bad equilibrium where yields increase, that typically also involves banks, because banks hold a large share, the domestic banks hold large shares of these government bonds, and as a result, they are in trouble because the value of these bonds declines. And we have this the loop between the banks and sovereigns, and we have tried to do something about this with the banking union, which was a first step to try to untie this link, but this is still an unfinished business also, right? As you know, the only very important element in there is the common supervision. We are nowhere in terms of common deposit insurance, and the common resolution mechanism is still very marginal. So as a result, I think if we get involved again in a major banking crisis, countries will be on their own again. And that's what we want to avoid, right? So we still have to do a lot of work there. I don't want to be too cynical. We have done a number of things, quite important, but we will have to do more.
Here, and then somebody there on the other side. Yes.
Yeah, thank you, Professor De Grauwe, for your very nice overview presentation. And it reminded me, so my name is Ad van Riet, it reminded me of your paper in 2011, so basically the first paper on the subject where you compared Spain with the UK.
Right.
So again, UK is a kind of benchmark, so it is very timely that also now we can witness what is happening in the UK and how then indeed the central bank acts as a lender of last resort. I just doubt a little bit about the role of market discipline in the context of the UK. I mean, of course, maybe it is difficult for the markets to drive the country to default, but maybe it can have a positive effect as well. So the drive to the good equilibrium, perhaps, that the markets are currently forcing the UK government to reconsider its budget program or its mini budget. I read even that the finance minister of the UK had a meeting with British and American banks, and they demanded basically that the government change its course and comes with a proper growth program. So don't you see the benefits?
No, I grant you this point. I mean, maybe I've been too cynical about financial markets. This was very much influenced by what happened prior to the financial crisis and then post-financial crisis, where we had that, right? I mean, in the period prior to the financial crisis, it was euphoria in many countries. Nobody saw risks. So it's not, I don't want to blame anybody, right? But so bankers didn't see the risks, nobody, academics didn't see the risk. And so articles were written about why in Spain now a new something had been realized, right? Something permanent, and it wasn't. It was just euphoria, right? And a bubble in real estate markets. And then came the crash, and then there was an excess in the other direction. So that's how I talked about this. But I grant you the point that, yes, sometimes financial markets can do the right thing and signal, in the case of the UK, for example, that this budget is lousy. Huh? It's not the right moment to do these things. I wonder what will happen. It's difficult to say, but my suspicion is that the people around Liz Truss, they are the free market fundamentalists, right? And they want to starve the beast. You know, this is what Reagan also wanted to do, starve the beast. The beast is the government, right? How do you starve the beast? You first massively reduce taxes. That creates a big deficit. And then you come out and say, we have to reduce spending, right? And that's what I think we'll want to do. But I'm speculating now. Given what I know about the people who are around the Prime Minister, right, the Patrick Minfords. Patrick Minford, a good friend of us, who dreams of a minimal state, you know, no regulations, all regulations are bad, and just reduce the size of the government. So I think that's part of the strategy. But the question is whether she will be able to do that, given the fact that in Parliament, among her own conservative faction, she doesn't have a support. Right? And so we could have something like Theresa May, who doesn't find a majority in some Parliament. But this is all speculation, right?
Okay, we'll have 3 more questions, and then we will shut down the session. And of course, Paul will join us for lunch, so perhaps he is willing also to answer questions over lunch. You first.
Arnaud Le Chevalier, University Paris 1, Panthéon-Sorbonne.
Bonjour.
It was a great pleasure to hear this presentation, and it will, in fact, nurture my own lecture in front of my students at the Sorbonne. 2 short questions. First one regarding the monetary policy. Will be a change of the treaty, making the ECB officially a lender of last resort, assuming is it possible with the frugal countries, a definitive solution. And now regarding the fiscal policy, you have often claimed in your works for a common fiscal policy at the EU level, or kind of mutualization. And that's we have had with the next future, the next generation package, but apparently it's not enough. Mm-hmm. So what should be made now for a common fiscal policy at the EU level?
Okay, on your first question, this is really a legal question, right? Do we need a change in the treaty to give the authority to the ECB to do what it is doing? Actually, the European Court of Justice came out with a ruling saying it's not necessary. The treaty today makes it possible for the ECB to do what it is doing. This was a ruling concerning OMT, right? Because the treaty and the statutes of the ECB are very clear. The ECB buys and sells marketable securities, right, in the secondary market. So what does marketable securities mean? Well, any security that is marketable, and government securities are marketable securities. There's no footnote in the treaty saying, be careful, when we mean marketable security, we don't mean government securities. No, nothing. So the ECB has the authority to do it, to buy and sell marketable securities in the market. So my personal view, of course, I'm not a legal expert, so you may contest it, but I'm backed by the European Court of Justice saying that the ECB did not transgress its mandate when it announced the OMT program. So I don't think we need a change in the treaty. So that's my answer to your first question. Your second question is a much more complicated question, right? How far should we go in a fiscal union? Of course, I ended my talk saying, well, you solve all these problems with the fiscal union. At the same time, you create a lot of problems also, right? Because how do you do that? It's so intrusive, a fiscal union, a budgetary union, giving the authority to one government to issue debt commonly. It's easily said, but it's such an intrusive way and change in our institutions that one can only dream of this, right? And I'm not sure, I don't know whether there is going to be a majority to go all the way there. I mean, at some point, some people may say, well, okay, fine, if that's the condition for keeping the euro, then we don't want the euro anymore, right? So we have to take that into account, that in some countries this could be the reaction. But that is, in fact, the solution. As I argued, where was the instability prior to the monetary union? In the foreign exchange market. What did we do? We abolished the foreign exchange market. This has shifted the risk to government bond markets. How can you solve this? By abolishing national government bond markets. And this will also do the trick of eliminating this kind of instability that I've been talking about. But it creates lots of other problems that have to do with political mechanism, governance, so I do think that at some point we will have to move further in that direction if we want to maintain the euro as something permanent. If we don't want to go in that direction any longer, then I think the euro will be something temporary.
You had two questions instead of one, and I promised there were three questions, so there's only one question left. I'll use my prerogative to make that my own question, but I won't ask it. I will just state something, and then we can discuss it over lunch, because it's time to go to lunch. So what I would like to ask, but I don't expect you to give an answer now, is to what extent all the things that you've mentioned, so the liquidity support and, let's say, fiscal support by the European Commission, in the end are just cover-ups of the original sin, in the sense that vulnerable countries were vulnerable countries in the 90s, and they're still vulnerable countries now. So the heterogeneity, or the fact that we are not equal, is a fundamental underlying problem. And how can we solve that if not just by covering it up?
I think you are too Calvinistic, right? Thinking that once you have the original sin, you cannot get out of this. I'm more Catholic than saying that sometimes you can do something about it.
Okay. Thanks a lot. Okay, let's have a big applause for Paul De Grauwe. And I hope you enjoy your lunch. See you later.